How's everyone doing today? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about bank stocks, just how are bank stocks performing in general. And I want to run through a series of 8 articles with everybody that runs from July through to August 9th of this year, just to give everybody kind of an idea as to what are some of the trends, what are some of the things that may be affecting bank stocks, and what can that tell us about where we may be ending up throughout the rest of the year here. So let's bring in our first article here, which basically is CRE, in other words, commercial real estate heavy bank stocks bow under pressure from investor scrutiny. And what this article basically says is that there are 2 key ratios that you look at. It's called the 300% and the 100% ratio. Those ratios basically give you a general understanding of what is the concentration risk in banks' commercial loan portfolios as it relates to commercial real estate. So if banks are over that 300% ratio, that generally tells you that banks have too much concentration in commercial real estate in their overall loan portfolio. And if they have basically, if they're over that 100%, they most likely have seen CRE loan growth of at least 50%, or they've got construction loans that total at least 100% of their risk-based capital. And so what we're seeing right now is that basically banks that are over that 100 or 300% threshold, their stocks are underperforming as opposed to other banks right now that are not. So commercial real estate is definitely leaning on bank stock values right now. Another thing that we're looking at here, so this next article is investors see inflection point in bank stocks. So, and this is from the Street Talk podcast. And what they go on to talk about is it basically, what is this gentleman? Joe Fenech, who's a chief investment officer at GenOp Capital Markets. He basically says that bank stocks, he sees them basically as improving, and that the long bear market in bank stocks ended in May of 2023. The investor said the recapitalization of New York Community Bank in March of 2024 could serve as the turning point of this investment cycle now that smart money has rescued some of the sector's biggest problems. This event reminds me very much of the recap of Bank United in 2009. Fenech said in the episode, the stocks bottomed first in the March of 2009, and then a few months later, you have John Knass and Carlyle recapping Bank United, and then that paves the way for the recap of the sector, and sentiment slowly got better from there. He goes on to add that basically bank stocks have faced great scrutiny, though since a trio of regional banks failed in the spring of 2029, the bank index has risen more than 40% since May of 2023. While the regional bank index has climbed 30% over the same period, the underperformance of regional banks was even greater earlier in 2024, but the gap has narrowed in the last month, with regional banks rising nearly 20% and the broader bank index gaining close to 10%. So he basically thinks that obviously credit losses are not as bad as some investors feared. Interest in the bank space would almost certainly increase. However, Fenech does see plenty of potential sellers looking to partner with another institution. He noted that the regulatory environment is limiting the pool of potential buyers. Those 2 conflicting dynamics could make this M&A cycle different from the ones in the past, he said. But he concluded by saying, I think there's no doubt there's pent-up demand for M&A, and maybe as soon as later this year it kicks off. But I just think it might look different than what we're used to seeing in the past. So, yes, and I would say right now I have reported on like kind of where bank M&A is right now, and we're probably on pace to do about 100, maybe a little over 100 transactions this year, which is very low compared to the last few years. Typically over the last 15 years, bank transactions are usually somewhere in that like 200 to 250 a year kind of range. And like I said, so being at 100 is definitely very low. So it would make sense that there would be pent up demand there. But like you said, the regulatory environment obviously is hurting that. And also the potential for credit losses. And again, commercial real estate exposure. These things are still dragging on the market. But this guy thinks that bank stocks can really take off. So, okay. Now we're at July 26th, and this says U.S. bank stocks swing on varying second quarter 2024 earnings results. So some individual U.S. bank stocks swung up and down as second quarter earnings highlighted the highs and lows. So what this basically goes on to tell us is that basically some banks perform well, some banks have not performed well, and that's basically due to a number of factors in the industry that we've talked about. But net income compression is definitely a big part of that. Let's see here if there's anything else in here. It talks about kind of like best performers. Okay, but the main thing is that there's been some mixed results, mainly between smaller banks, regional banks, depending on the size of the bank, what some other particulars and stuff like that. Now let's take a look at the next thing. So shareholder activism surges at non-bank financial institutions. So shareholder activism at non-bank financial institutions spiked in 2023 and continues to soar in 2024. Investors launched 115 campaigns targeting non-bank financial institutions last year. This year is set to blow past that mark at 101 such campaigns were waged in just the first 6 months alone. Asset managers are the most common campaign target, comprising 39% of all non-bank financial institution activism targets since 2019. So again, I think this is very interesting that basically, activist campaigns are really up against, non-U.S. are up against basically U.S. non-bank financial companies. So that could be putting, pressure on some of these non-bank companies to basically get, perhaps partner up. Just as the last article suggested, how M&A activity could pick up. So it says right here, like a hot equity market and cool M&A spell have driven more activism activity in general. Shareholders are targeted increasingly visible underperforming companies to maximize their gains and spur turnaround. So have to keep an eye on that. Now we're back. So big U.S. bank stocks rally behind regional peers amid varying net interest income projections. This is kind of like what I was just saying. So share performance at the 4 biggest U.S. banks lagged behind a rally in regional banks during the early part of the second quarter earnings season amid differences in net interest income projections among the major leaders. So again, you see kind of the performance here of the big 4. And it says that, big banks have vastly outperformed smaller banks so far this year after recent woes at New York Community Bank Corp. However, the path of net interest income bottoms has appeared clearer for the regionals, while asset sensitivity has clouded the outlook for big banks as expectations for rate cuts have solidified once again. Lower rates could also create an off-ramp for strained commercial real estate borrowers at regional banks with large concentrations. So in other words, they're hoping for rate cuts here. Let's continue on. U.S. bank stock rally pending rate cuts set to unleash pent-up M&A demand. So U.S. bank M&A is set to make a strong return once several headwinds holding it back subside. The 2023 bank deal drought was forecast to end in 2024, but at the half-year point, there is little relief for banks hesitant to jump back into the deal-making deal end. Through June 30th, 59 U.S. bank deals were announced, with much of that momentum coming from the second quarter with 32 deal announcements. Deal value also ticked up in the second quarter with several large deal announcements. However, overall activity remains muted. Persistently high interest rates, strict regulatory expectations, and stock undervaluation are still sidelining buyers that would otherwise participate in deal making, deal advisors said. But with rate cuts now on the horizon, banks stocks rallying, and the potential for a new administration, bank M&A could experience a boost by year end, advisors say. So, and now here's a new wrinkle there. So now we got interest rate cuts. But then they dropped an interesting thing there, a new administration. In other words, if Trump gets elected. So they're saying that basically if Republicans get back in office, that could be a potential that could really help bank stocks, because they'll see basically an easing of regulation and easing of interest rates. And then that could kick off a bunch more M&A activity. Okay, let's go here. So now we're at August 9th. So a couple articles from Friday. So few banks post positive returns as recession fears spark sell-off. So only 6 U.S. banks posted positive stock price returns for the week ended August 7th as markets reeled in the wake of a disappointing jobs report. So the industry underperformed relative to the broader market during the period, with the KBW Nasdaq Bank Index falling 9% compared to a 5.8% decline for the S&P 500. The underperformance followed a lackluster jobs report from the Bureau of Labor Statistics that reignited recession fears among investors. The sell-off prompted a spike in the Chicago Board Options Exchange Volatility Index, or the VIX, a measurement of the 30-day expected volatility of the S&P 500, which for the week hit a peak intraday high of 65.7 on August 5th after opening at a 16.7 on July 31st. So, and then the last article here is market pullback extends into August. U.S. stocks remain largely up year to date. A bumpy few weeks pulled U.S. stocks down from the recent peaks, though equities remain in positive territory for the year amid an uptick in market volatility. So since hitting an all-time high July 16th, the S&P 500 has fallen 6.1% through August 8th. The U.S. Federal Reserve's ongoing hold on lower interest rates amid cooling inflation and rising unemployment, fears of a recession, and the recent unwinding of the yen carry trade have all contributed to a broader market sell-off in recent weeks. Still, stocks are generally up since the start of 2024 as the anticipation of Fed rate cuts and enthusiasm over artificial intelligence technologies pushed markets higher. So now we have yet another piece here to add on to the anticipation of rate cuts. Now we also have the enthusiasm over artificial intelligence. Well, and I have some interesting things on that because I am going to be doing a whole series on AI and basically some of the things. But the nuts and bolts of that, the overall opinion there is that I think we are in a little bit of an AI bubble, and I don't think that AI is really delivering the revenues and the income that a lot of people thought it would. And so I think you're going to begin to see a little bit of a pullback in the whole kind of AI trade, so to speak. But ultimately, what do these articles tell us here? Like, where are bank stocks? So bank stocks are mostly up for the year, though the last couple of weeks have been pretty rough. We've seen a little bit of a pullback where there are lingering issues. We got credit quality, real estate concentrations, regulatory, constraints right there. You're in the middle of an election season. We've got this AI enthusiasm. So there's a lot of different things going on there. But basically, the market is hoping ultimately for rate cuts, rate cuts and potentially a new presidential administration that would probably ease back on some of the regulatory issues or regulatory burden, as it were, out there right now. And those things will probably, if those things come to fruition, toward the end of this year into next year, you'll probably see a pickup in M&A activity. Ultimately, you'll see a pickup in bank stocks, and off we go. So that hopefully that kind of gives everybody just a little idea, a little guidance as to like where the market is right now at the moment with bank stocks and how just everything is kind of unfolding at the moment. So obviously a lot of stuff here to keep an eye on, and we will as we continue to move forward there. But I just thought this was good to just kind of look at this over over the last month, just to kind of get a better perspective as to like what's going on with bank stocks, what are the general issues impacting them right now, and where do we go from here for the rest of the year. So okay, so if I hope everybody, and I hope that was good. I hope everybody got something out of this, and they this is not financial advice, though. Don't be buying bank stocks on this. I'm not a financial advisor. I'm not giving stock information here. Okay, but like I said, and outside of this, I hope everybody went and checked out. I did a couple of live streams yesterday, which I hope people will do. I did a live stream on YouTube to celebrate the 1 year anniversary of the channel. I also did a live stream on Podbean for the podcast audience. So I hope that everybody will get a chance to check that out. I debuted for the live stream basically this new show concept, which is going to be called Strategy Room. And I'm hoping long term that I'm going to be able to use that to ultimately kind of replace the weekly update, because I'll be doing a weekly live stream show. So, but like I said, that'll continue to develop over the next couple of weeks, and I'll definitely have more stuff to roll out with that, and that will continue to evolve here over the next couple of months. And hopefully everybody will enjoy that, as like I said, as the channel kind of continues to evolve and grow here. So, but if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Please make sure to leave your comments down below. Remember, we are on YouTube, Rumble, and all major podcast platforms. I hope everybody has a wonderful week out there, and I will see you all again soon. Thanks a lot.